We've got the thumbs up from Ethan. That means we're good to go live. Good morning, sir.
Hi, Jacob.
How are you doing?
Doing well, thank you.
I must say, your socks, your outfit, your entire attire is on point today.
Well, you're on brand.
I'm on brand, but I'm not. Am I on point though? You said I'm on
Yeah,
brand.
yeah, no, you're on point. You look
sure?
great. Yeah, we're men in black together.
We're men in black together?
Yeah.
That's what we like to hear. Introducing everybody to David Frodsham. We're about to talk about how to raise external finance for your business and the things that you need to look out for if this is something that you're considering. But before we go into it, just want to say good morning to everybody. Let us know where you're watching from. Let us know how long you've been in business for. And throughout the conversation that I'll be having with David today, feel free to put your questions in the comments because we will have a Q&A later on during this conversation. So, you ready to go?
I am.
Okay, so just to prove that you're not an alien,
Okay.
right? Can you let people know who you are? What is your background? How did you get into where you are in life right now?
So I'm really a sort of recycled entrepreneur because I was a tech entrepreneur for many years, and about 15 years ago, I decided to change because I'd really enjoyed during my career corporate finance and raising money, buying businesses, and so on. And so about 15 years ago, I set up a corporate finance boutique that helps companies raise money, also buy other businesses or sell their own businesses. I'm also a business school lecturer on venture capital, and I have a podcast on venture capital called Venturing On.
So you've got your own podcast as well.
Yeah.
So what's that podcast on?
So it's on venture capital. It's on LinkedIn, and it's conversations with entrepreneurs and with investors about venture capital.
Yeah. So making that jump from, as you said, being an entrepreneur yourself into purely the finance side part of things, why that jump?
Someone joked that I didn't want to be the only CEO with an ear trumpet, but I don't think it was really that. I think it's just the finance side has always interested me. And I still feel that the finance industry doesn't serve entrepreneurs particularly well, and that's what I set out to try and help.
Yeah. Well, hopefully in this conversation, you'll be able to usher people into a deeper awareness of some of the things that they need to be consider in their own business.
Hopefully, let's see.
Hopefully. Okay, so what is external finance?
Well, external finance is raising capital from someone has no connection with you other than a contract. So it doesn't mean borrowing 50 grand from your favorite aunt, or investing your life savings, or any of those sort of things. It means raising it from an external party. Now, you can of course get there's lots of bank loans available, or invoice discounting, factoring, and so on. My particular area of interest is in equity, so selling shares, raising money by selling part of your business to a third party.
Yeah. So I think you just touched on it slightly, but what are the different types of external finance that are available for people to be made aware of? So just in case, in layman's terms, if somebody's wanting to know what external finance is and which different streams of external finance are possible out there, what are those things?
Yeah, so you can look at it from two perspectives. One is, where does it come into the company? Does it come in as a loan, or does it come in as shares? Does it come in as equity? And then where are you going to get it from? Are you going to get it from a financial institution, a group of individuals, from a fund, or maybe even these days there's a lot of sort of mixed money, grant money, and mixed up with other support. The equity portion is particularly interesting because, of course, you're no longer the sole owner of your business. You have, if you like, a business partner who's more of a sleeping partner, hopefully, but you no longer have full control of your business. It's an important thing.
Yeah.
Because I mean, almost the most important thing, Jacob, is that if you bring a external shareholder in, you have to give them a way out. They're not going to be there forever. They need to be able to make a return, and so you're putting your company up for sale the moment you bring in external finance, because there has to be a mechanism to get them out.
Well, that's one of the questions I was going to ask later on in regards to how long kind of company have external finance for. So that's something that we'll talk about further down the line.
Do we have to do all the questions in your? We could do them in a different order.
Oh gosh. So how long does a company have to have finance for, basically?
Yeah. So most external investors will operate in a 10-year fund, and that means that during they raise the money and they invest it, and then they realize it, which means that they manage to they get their money back out again with a return. That means that probably it's a 5-year time frame, because you've got to allow the time how old the fund is and allow time for it to be sold at the end. But 3 years is perfect. 5 years is fine. Some funds are what's called evergreen, which means that they can essentially go on forever or be renewed. But that's quite rare. Most of them are 10-year funds.
Yeah. So in the case where it gets to a few years into a company receiving investment, and it's not necessarily looking good for the investor in regards to receiving a return of investment on what they've put in, what's stopping the investor from, or stopping an investor from just saying, give me my money back right now, I want to go tomorrow?
Well, that's really down to the amount of control there is in the investment agreement. So as I said right at the beginning, they will have a mechanism to get out, to force a sale out. But it's very hard to sell the business or get their money out without the collaboration and cooperation of the owners of the business or the management of the business. And therefore they will prefer always to work with the management to say, okay, now we want to see if we can sell the whole company, or just sell our stake to someone else. But to answer your question, if they get impatient, it probably means that the CEO's role or position is at risk.
Okay.
Because the best way to do it is to fire the CEO and bring someone else in
Okay.
to do that.
And that's dependent on for example, not in every business, the CEO is not always the owner of a business.
But it could be. I mean, they will have, particularly a venture capital investor, will have the power to dismiss the CEO, even if he's a majority owner of the business.
Even if the CEO is a majority owner?
Yeah.
Wow.
Why don't we start with all the sort of negative? Can we go to the positive?
Oh, gosh. So how does a business raise external finance?
Well, I think you've first of all got to understand, or the entrepreneur or the CEO has to understand, why do you need money? And I think whenever I ask a CEO, why do you need money? They normally say, well, it's to hire an engineer or it's to pay the salaries at the end of the month. But actually, if you're much more analytical about this and say, why is it you need money? You need it for a number of reasons. So you might just need to invest in the product or services. So you might need to buy equipment or hire a whole lot of developers to build a software product or whatever. So you might need to build the product. Secondly, you may need money to service customers. If the customers pay you more, if it's an e-commerce business and you have to pay for the stock before you can sell it, that's working capital. So the second thing you might need is working capital. The thing about working capital is the faster you grow, the more you need it. So you may need more capital.
Yeah.
And then the third area is that the company may be unprofitable over a period of time. So those are the three areas. So why does a company need money is the first thing to answer. And that's almost more important than what stage you need to be at, because very early stage companies need capital because they need to build their product and they're probably making losses. Mid-stage companies, if they're growing, may need it for working capital and for expansion. And then later stage companies, hopefully they're profitable, hopefully they're generating cash, but they may need it for replacement capital for shareholders or for an acquisition or some other kind of. So that's the very first question I deliberately didn't answer your question, but the sort of sub-question in that
no. That's
is
very...
you have to first of all work out why you need it.
Yeah.
And what it's going to be used for.
Yeah.
Generally, venture capital to use it for working capital is very expensive. So it's better if you can really focus it on building the product or for the growing of the business rather than the working capital.
Yeah. So once a business basically understands why they need the finance in the first place, that's like the first step to get into why you need to get.
Yeah, so investors prefer to be part of the scaling up of the business rather than the creation of the business. So if you have a wonderful idea, Jacob, to do, I don't know, make a lot of money out of podcasts or something, an investor would say, great, you go and create your business and then we'll help you scale it up. So you go back to them and say, yes, I've got an audience. I now need to go and buy equipment. I need to hire some people. I need to do some marketing to acquire more views or whatever. That's the stage they like to invest. They like to scale up.
Yeah. So how about somebody, because our audience are SMEs and a lot of startups as well. Once a business leaves that stage of being a startup, what sort of finance may be available then if the example you just used of an investor wanting to be involved or looking to be involved in the ascension stage? What sort of was somebody that's not a
What's
startup?
the profile, do you mean?
So,
yeah. So the investors are very keen on unit economics. So unit economics is the cost of customer acquisition, or whatever a customer means, and the lifetime value of that particular customer. So if you're doing your podcast business and you want to really scale it up, your your unit is what does it cost you to get another viewer, and how long will they stay there, and what the value that you can get through the advertising revenue or whatever from that one viewer. The economics around that are really something that an investor will look at very closely, because they could take the view, well, Jacob, I'll give you more money than you think that you need, because that means that you can invest it faster in customer acquisition, which will generate a faster growth rate, which will give you a bigger and more valuable company later on.
Yeah. I have I've not sent you this question I'm about to ask. So, okay. So if, does it matter the sort of sector you're in when you're trying to position yourself to seek investment?
It does.
Okay.
So venture capital in particular are looking for companies that have high potential. So the economics of a venture firm is that they're really looking for a 10x return on their money. I can explain. They have to get at least 3x, otherwise the economics don't work for them. But they like to shoot for a 10x if they can, because then they'll be very happy with that. But that's not going to happen in real estate. It's not going to happen in a lot of other businesses that just can't promise that return. So to consider venture capital, you have to have potential, high potential.
Can you give me an example of a high potential sector?
There are a lot of them. I mean, what you're doing. I mean, in the whole area of internet engagement, web engagement, everything that means in terms of marketing services or whatever. E-commerce can be that. Financial services can be that. Lots of things can. It's harder to use venture capital for something that is that doesn't have those very high growth potential. I mean, it can even be healthcare. So a famous recent example around the companies that produced designed the early COVID vaccines, because a couple of them were startups, and so Moderna, for example, went from when the COVID pandemic started, they were doing 8 million of revenue. And in 6 quarters, it went to whatever it was, 7 billion.
Did you invest in that?
I didn't.
Oh.
I didn't know. I should have done, really, shouldn't I? But I'm an advisor, remember. I should have advised them.
You should have advised them.
Exactly.
For a fee.
Exactly. Well, just a very, very small and well-earned slice.
Oh, no, that's true. So the sector that you are in does play a factor.
It does play a factor, but basically, I mean, for us as advisors, we don't care, because a company is a company, has the same fixed assets, working capital, unit economics, valuation, all those other things that finance people worry about and are interested in. They all have the same characteristics.
Yeah.
But venture investors don't like. Well, venture investors want high potential businesses.
Yeah. So just got a few comments here. So just in case you are joining us now, we have, or I've established from some of the things that David has said, is that the sector that you are in, especially when seeking venture capital investment, does play a role.
Correct.
And also, before you go out in looking for external finance, you must first understand yourself why you need it. That's basically the most important thing.
And you have to accept that you're going to lose some control, because the investor needs to have a route out for his investment at the end of it.
How much control does, let's say, this podcast, I want to get it to 1 trillion people, and I'm seeking some money to do that. How much control do I actually have once I receive investment into my company?
Yeah, it's a great question. So I need to a little bit separate between private equity and venture capital. And if it's helpful, I can explain the difference. But
Yeah.
private, they're generally lumped together, but they're really very different. So private equity is essentially an owner of a business, so they tend to own a majority of it. They might own it, co-own it with management, but they have very tight control, and it's essentially their business. Venture capital are minority investors. They will invest their companies are high growth, often loss making. Private equity, generally later stage, profitable, and on the venture side, so the private equity have control because they own the business.
Yep. So they have private equity has full control of the business once
Because
they invest in.
because they'll have a majority.
Yeah.
These are all speaking generalities, but
Yeah.
but they'll typically own a majority, and then the management are along for the ride in the sense of participating in the growth. Whereas a venture investor has a minority investment, so the control comes through the investment agreement rather than just being able to outvote them in the shareholders or in the board.
Yeah.
And there are certain clauses in the investment agreement that give them control. So they'll have things like reserve matters, which means that there are certain things that the management can't do without the specific approval of the investor. And then they'll have probably the most important is a thing called drag rights, which means that if the investor wants to sell their shares, they can drag all the other shareholders with them. That's what drag rights are called. But so the answer is operationally, venture investors are much more hands off. The management should be able to carry on and do what they want. But ultimately, when it comes to a corporate finance transaction, selling the business or some kind of exit or replacement, then the investors will have control.
Have control. Okay. So in private equity, they become the major share owners of the company, and venture capitalists, that's the route where they're minority shareholders. But based on what you said before, they still have the ability to kick the CEO in the backside if the CEO is not behaving themselves.
Absolutely.
Okay.
I mean, if you want to simply put, is a private equity is an owner, venture capital is an investor.
Yeah. Oh, I've got a good question. So you know when somebody, for example, I'm not trying to plug Trading 212 here, for example, but if I buy a share in Amazon, for example, on one of these investment platforms, does that make me an investor, like a venture capitalist investor, or what does that make me at that stage? How much of the company do I actually own?
I'm going to be very political about this and answer a slightly different question. You can always bring me back at the end of it. So I think the closest analogy to that is crowdfunding. So we're seeing crowdfunding, like Crowdcube and Seeders and so on. And what they do is offer venture style investing to an individual. If you say, I really like the look of this company, and I'll put in, a few £100 or £1,000 or whatever, and hope to get a sort of very big return. And some very famous companies have been through that route. Revolut started with a crowdfunding at a very low valuation. It is now worth more than Barclays. That can be extremely successful, but generally speaking, the people with money invest in a fund. The fund is managed by the venture firm, and they invest that. So you don't, with the exception obviously is crowdfunding, you generally wouldn't, if you're investing in a venture firm, you wouldn't have an individual company in your portfolio. You've invested in their entire portfolio of companies.
Yeah, that makes sense.
I mean, typically, it might be worth just mentioning that venture firms that raise funds, the people who invest in them are generally not individuals. They can be pension funds, because they've got to think about the 10 years. It's got to be organisations that don't need the money in the short term. So a pension fund is typical, is that they know they've got a liability coming up in 20 years' time, and therefore they can invest in venture firms, be very patient.
Yeah.
It's a patient capital model.
Yeah.
It does appeal to some family offices that are, wealthy families that are prepared to take a long-term view, but generally these are institutions investing in venture capital.
Yeah, no, thank you for clarifying that. Got some really good questions coming in so far.
Excellent.
So we'll come to those in a bit.
We're going to deal with not so good questions. Is that what you're saying first? Okay.
Yeah. Next question I have. What does a business need to do to make themselves an attractive proposition for
What a great
an
question.
investor?
What a great question. So I mentioned potential. You've got to have a story that says that this company can be very big or very successful in its particular, over a period of time, over a period of a few years. So that story is very important. The unit economics, far more important than the profitability of the business. In fact, the profitability is less important, but the unit economics, which are how fast do I invest and what kind of return does that generate over time. I think, we were talking before about the sector. There is a thing about hot sectors that they tend to get a little bit overpriced. And being in a hot new sector, and the investors may think that they're going to. There's a sort of fear of missing out, FOMO kind of thing. But the best thing the best advice I can give is be on top of your unit economics and have a great growth story.
Yeah, oh, that's good. So be on top of your unit economics and have a cracking growth story.
Cracking is a great word.
There we go. Moving on. If I was a business owner seeking external finance, where can I find it? So, for example, literally as simple as what do I type in on Google? What communities should I have my ear to? What are the places that I need to go to speak to the people that I'm wanting to speak to get this finance?
Yeah, that's so. There are a number of organisations like BVCA, the British Venture Capital Association. There's it's quite helpful, I think, to speak to someone who's already raised money so that you can get some recommendations. I think it's definitely worth going to speak to Seeders, Crowdcube, etc. The platforms that do crowdfunding, because they run pitch events. There are accelerators. Accelerators are companies that, in exchange for a share of your business, they'll help you develop your story, and introduce you to investors. And so you go through a program with them. But I accept the fact that it's difficult because venture firms are typically quite small and they get way more approaches than they can deal with. So they have to be quite rigorous about filtering out. So you've got to get your story right, get an introduction, get their ear, and then take it from there.
So I'm guessing once you get in front of the people that you're wanting to be in front of, what you're talking about there, like the what we call the elevator pitch, making sure that you get things like that to a T. Is that where, like, the accelerator groups, is that where they help?
They said they can certainly help that. They can work on the financial model. They can work on your positioning, competitive analysis, etc. All of those things. I would add one other thing which is relevant in the UK is the role of EIS or SEIS. So the tax breaks offered by the government for private investors to invest. So that's trying to overcome this gap between your aunt who's given you a few quid to get you going to before you go to a venture firm to raise money. It's trying to bridge that gap. But there are now funds, EIS funds, that will invest, $1 million or 2 million or up to 5 million, that kind of band. that can help you accelerate your business. So they are also worth talking to.
Okay.
EIS is and your company has to be eligible for EIS, so you can talk to your accountant about what makes your company eligible.
Yeah. So there are multiple there's multiple things that somebody needs to a business owner or the business need to make sure they get right positionally before they actually put themselves in front of an investor. Is that basically?
Yeah.
Okay.
Yeah. I mean, I think the most disappointing thing for an entrepreneur is to find that an investor doesn't like the stage that they're at, and the reason, for example, that the company doesn't yet have enough traction, or is in the wrong sector, or is maybe too late, because each venture firm will have its preferred
Entry point.
Yeah. And just because they say no doesn't mean to say you're a bad company, or it just means it's not right for them.
Yeah.
And so you're going to have to kiss a lot of frogs.
Yeah. I think this leads me on to my next question, which is, at what stage in a company's development would they want to consider themselves for external finance?
Yeah. So it's obviously better if you can manage without, because you want to retain as much ownership of the company as you can. But venture capital brings an acceleration of the business through their cash, but also they may bring contacts and connections to enable you to, for example, expand internationally, or enter a new sector, or help you with a new business model. So the question is actually quite hard to answer, because it really is as simple as to the risk is lower and the potential is higher. You know, there's the joke about capitalism that it's where they invest when the greed is larger than the fear, and that's really true in venture investing. Is when the investor feels the potential outweighs the risk, that's when they'll invest.
That's when they'll invest.
Yeah.
Okay. You just gave me a political answer there.
Yeah, I did. I did. You can ask the question again if you want.
Yeah. But so at what stage I'll give some scenarios here. So if I'm starting up in business, I've got my business plan, I have investment from my own personal savings, some contribution from parents, from family, have a few bank loans, and I've started making some money. Some money has started to come into the business. Using that as a scenario, is that a stage where I could now begin to court some investment?
Potentially. As I say, it's about the story of the potential. So they prefer to scale up, right? So if you're saying, I have revenue, so you're starting at the graph is starting to look like this, and if you can do a story to say, with your money, Mr. Investor, I can really accelerate my business. That's the point.
Yeah.
If you'd said all the things you said, but I'm hoping to get some revenue soon, I would say it's too early. Okay. You've got to have customers. There are exceptions like healthcare and so on, which you may never have customers, but you've got to get to the point where you're saying, look, it all works. The unit economics works. The defense, I can outcompete my competition. All I need to do is scale it up. Yeah, that's the best time.
Yeah. So just to reiterate, because I know that there's a few people watching this and wanting to watch this who have businesses at this stage where what they said on the tin is actually working. They've got some clientele, revenues coming in. You are at the stage where you can position yourself for investment. And also, if you get your story right, if you get your pitch right, or start working in it, from what I'm getting from this conversation is that there are investors who are looking for people like you.
Yeah, but I would also turn around and say to the entrepreneur, sit down and do a scenario where you don't have external money, and what does the growth look like without external money? Maybe it's not possible at all, but maybe it's just slower. And then what would it look like with external money? If you really, it's going to make a difference, a huge difference. Your company's going to be very much bigger, very much more successful, or exist at all. Then obviously that's the time to bring in investment.
Yeah. I'm going to just, before I go into questions, I'm going to read one of the questions from the comments.
Great.
We have Arnold. He says, listening from Southwest London, and we have two startups that have just come into operation. My question is whether UK and US, he puts Silicon Valley, venture capital will work the same.
Arnold, great question. Thank you for the question. It is different because but the fundamental difference is it's bigger. So an angel investor, if I go to sort of pre-VC, in the US will typically invest more, and therefore you can get your venture further along the path of development in the US before you raise venture. I still think they're looking for the same things. They're still looking for unit economics. They're still looking for growth potential. They'll still have the similar clauses that I've talked about earlier in their investment agreement, but they will tend to invest larger amounts. I don't think for a couple of startups in Southwest London that it's the right place to go and look for venture in Silicon Valley. It will be relevant if you can get to being very much later and needing a large amount of capital.
Yeah, he actually said as well, and if one is preferred for, is there a particular UK? So obviously Silicon Valley is this big behemoth thing all the way over there.
Yeah.
Is there a place similar to in the UK where people
Similar locations.
Similar location.
Okay, so let me just say about Silicon Valley investing. There is this saying about the McDonald's kind of investing, and what that means is that, and this is true, I think, in the old days, is that you take rather an indifferent product, warm it up a bit, and then flip it to the Americans. That was called the McDonald's investing. So that I don't think that really works so well anymore. Is that you've got to have real potential in the business here on its own, and London is still the capital of venture in Europe. It's one of the global capitals. It is probably still the best fishing ground even for people from outside the UK or from the regions or whatever. London is the place to go for venture. Remember, the US has got lots of other hubs other than Silicon Valley. You know, there are a lot of venture investors in New York, for example, and Boston, and so on.
Yeah. Another question. Might as well go through a few of these.
Yeah.
I've got a question from Twitter. What is the best way to send a pitch or a deck to investors? Is it print bound, doc send, email?
SlideShare.
SlideShare?
I mean, the best way to do it is to have a conversation first. But to deliver the materials, probably some kind of online sharing things like SlideShare. But there's nothing to beat. You know, one of the things that venture firms are looking for is the quality of the team. Because no point in being in a hot sector with lots of potential, but actually having a very cautious management team. Says, we've got to move forward slowly. We've got to make, step by step. They've got to have confidence that the team has ambition and capabilities, competence. and so the best thing is to meet with them. It is the best.
Yeah. So I've heard this saying before. I'm not too sure if you're familiar with Stephen Bartlett.
Yep.
So that investors invest in the people.
They do.
Right. Even if they, I remember there's actually a question about Dragon's Den here, which we'll come to. But there was an episode on Dragon's Den a few years ago where Levi Roots went into Dragon's Den with reggae sauce. Amazing song. I remember like it was yesterday. And he necessarily didn't have the business nous, or it didn't come across that he had the business nous. But his charisma, the passion, the eagerness to learn and to also seek advice and to take what he's got to another level, it was all there. So it was clear to see that these investors not only recognized that there was a product with a lot of potential here, but this character, I almost called him a WWE wrestler, because that's what it is. This character that Levi was the main attraction for the business. So just to add on
but
to what you said,
it's one element. I mean, it's I don't want to get political here, but it's a bit like politicians. You know, charisma is just one element. You also got to be able to do.
Oh, don't mention any names.
No, we're not going to get there.
I think I know what you're talking about.
But in the case of Levi Roots, I believe what it was is he had the product. You know, we talked about the product needs to be there. He had the product, but he got a sample order from one of the big chains, and I think it was like 1 million bottles or something.
Yeah.
So there he is, cooking it up in the saucepan and in his grand's kitchen, and he has to go from there to 1 million bottles. So what does that mean? You've got to have working capital, by the way, because you've got to be able to build your inventory, and you've also got to have the relationships. You've got to have the supply chain sorted out, and charisma isn't enough for those. You've got to have finance. You've got to have a team around that. So I think a venture investor would be looking not just for him as a fantastic spokesman and promoter of the brand, but people behind him who can deliver, and people who can understand how much money is needed to go from a kitchen to a full scale food production with all that entails.
No, that's really good.
But he's a great entrepreneur. I agree.
Yeah, that's really good. Another question here. On Shark Tank, for example, or Dragon's Den, how accurate are programs like Dragon's Den and Shark Tank when it comes to getting real life investment?
Yeah, so I'm a little bit anti Dragon's Den for one particular reason. I'll explain it, which is that it's set up in an adversarial background, because that makes for good television. Whereas business really isn't like that. You know, if you're speaking to an investor wants to be on your side. They want you to be successful. They want to work in partnership with you. So although they'll ask difficult and probing and direct questions, it won't be done in such a sort of antagonistic, sort of kind of negative way.
Yeah.
I do think the other thing is that they tend to be a little bit earlier. They tend to be more, here are my ideas. Whereas a venture investor is saying, great, you've got your idea, but tell me about the traction. Well, I've got my first 100 customers and I've got orders for my 1 million samples, and I need help in ramping it up.
Yeah. No,
but it's the mood I don't like in Dragon's Den.
Yeah. You just made a good point there about like it's like the judges are in competition, number one, and also they're very, very. It's like you're in a head teacher's class, head teacher's office. Like they're really, really like coming for you with the questions. It's quite intense.
I think the best venture investors are extremely nice, friendly people who really understand business and will be happy to challenge you, push you, or whatever. But they want to work. You know, if you take their investment, you're going to be great friends for 5 years or however long the investment is in there, and you better like each other's company, right?
Yeah. Well, I've got a question just off the back of what you just said. So does a business owner need to be careful with the person that they eventually choose to be their partner, right?
Very much so. So it's one of the people like me say, well, you should do due diligence on your investors, make sure you can work with them, and so on. But the reality is that there's more demand than supply for investment. So you may say, do you have £1 million? I like you, rather than any other criteria. But
Yeah.
it is, it can cause huge problems if you end up with an investor who you don't get on with.
Yeah, well, that's very important. Another question here. Gosh, it's like we moved on to the Q&A. I've not even finished my questions yet. Can you guys don't slow down, but just take it easy. I want to get my questions in first.
Particularly as I don't answer them.
I've got a question here from Global Local Finance.
Okay.
My company, my company work with a number of startups, and would be interested in connecting them with angel investors and VCs when they get to the scale-up stage. How would you suggest getting in contact with them?
Yeah, so the angels are easier, and there are a lot of angel communities, because it's probably, if you're an angel investor, it's your biggest problem is that you've got so many people approaching you, and you just don't have enough time to be able to sort of weed through them. But there are angel networks around which are really worth getting to know, and they run pitch evenings and opportunities to meet angels. The venture one, as I mentioned earlier, is more difficult. The best way into a venture investor is through an introduction.
Introduction from
Someone who's already taken investment from them or who knows them.
Okay. On what you just said before, do you have any recommendations on some of these angel networks that you may know, or so we can point people in that direction, or?
There are a lot of them. I mean, I don't think I'd pick one out but they're fairly easy to find.
Okay, that's fair enough. What advice would you give to business owners going from running things alone to being accountable to a board of directors and investors?
Yeah, I think the I'm going to start with the positive thing, but it is having a board of investors, a board of directors, is a positive thing, even if you retain 100% ownership, because if you bring in some wisdom and experience, you can benefit from that. There's no individual is smarter than all of us, if you see what I mean. And I think also the discipline of saying we set targets, we measure what we've done, we see how we can improve, are all things that a board of directors will help you with. And I would encourage people to do that, independent of the investors. Part of the problem, I think, if you bring in an investor, so first of all, they will bring that discipline. You will have monthly or quarterly or wherever it is board meetings. You'll have to prepare results. You have to explain why you've missed your targets or why you've exceeded them. In other words, you can't deliver or you can't plan. It's kind of the problem is where the variance analysis comes in. But I think it's a thing that you should welcome. And I said earlier that venture capitalists are not looking to dominate the dialogue with you. They want to leave you the free space to go and be successful.
Yeah.
So anyway, yes, board of directors is a cool thing.
Yeah. I think that's end of those questions for now. If you do have more questions that I've not already asked, or something that David's not already answered, please feel free to put them in this chat. We want to squeeze as much information and as much value from David whilst we've got him here.
May I ask a question?
Yeah.
Okay. So why does a venture capitalist not invest? Why do they not provide loans? So there's a thing called venture debt. So what is that? Jacob, it's up to you.
So David, why does a venture capital not provide debt?
Yeah. Okay. So there is a thing called venture debt, and there are things. So, but basically, the answer is that it is the way a venture firm works. Is I mentioned that they're looking for a 10x return. If you go to investors with a 10-year fund, and you charge a management fee, and you take money in, and then you recycle it out, every pound or euro or dollar that goes in needs to be really 3 on the way out for the investors to be happy, and for the venture firm to pay their expenses. It's just a, you can do that on Excel to show that. So that's the first hurdle, is you have to take 1 unit of money and make it 3 units of money. Why they want to, and that's very hard to see if that's debt. I'm going to lend you £1, Jacob, but I'd like you to give me 3 back. You probably have me arrested for, being a shark loan shark. Or whatever. So they want to invest in shares where they'll share in the upside of the business. There are a couple of exceptions that are worth pointing out. So one is venture debt. Venture debt is a type of sort of hybrid finance where they will invest alongside other investors, and they will assume that they can therefore reduce their risk, and they will build into that an automatic return, which is typically over 10%, maybe closer to 15%, and they will take some warrants. So they are kind of slightly lowering their financial risk, but they're still getting a very good return in order to be able to get sort of venture-like returns. So it's not really debt as you and I know it. And then the other one is very common, convertible loans, where, and this happens in early stage businesses. So if you want you want to get to your 1 billion viewers on your podcast, but at the moment you only have 100, then and it's very early stage, and someone's really interested in what you're doing, they may say, I will give you a money that will convert, some investment that will convert into shares later, but I just can't price it right now. And that's a convertible loan, or what's called a SAFE, sometimes a simple agreement for future equity. And however, it goes back to the basic rules: is no one's going to lend you money because either you're going to be very successful or you're going to get bust. They don't want to lend you the money and find you go bust, or lend you the money and find that they don't share in the growth of the business. So you've got to think about, that's the reason why venture investors don't invest in debt typically, with those 2 exceptions.
Yeah. Just looking through my questions here. I think one of the questions you've already answered this was, how long does a business have access to investment for before they have to pay it back?
Okay. So let's suppose that we'll go back to your example of your podcasting business, and you say, well, look, I need $1 million now because I need to buy a lot of equipment, and I need to get motoring and put some money into the customer acquisition and so on. But if this really goes wild, I need another 10 million, right? Or I need another 5 million or whatever, because I need to go global. And what you may find is an investor says, okay, I'm going to invest in tranches. I'll give you $1 million now, and I'll give you another $1 million later, and I'll give you another $1 million beyond that. And I'm generally advise against tranches, because it's very difficult to see what the conditions are that you can be sure that the investor is committed to put the next money in. Is it really just at their whim? In which case you'd probably be better off not taking it and then being able to argue up the price, or be able to get the money from someone else. So that's how the money goes in. So generally, tranching is very common, but it sounds a very good idea, but it basically isn't. You were asking also about the other end, how long for? So the funds are typically, as I say, 10 years, and that means 5, it can be 7 years, but in that sort of 3 to 7 year period, they want to get their money out.
Okay. Is that always the case?
No, it's not always the case. As I said, there are some evergreen funds that can, but generally speaking, because of the economics of it, it ends up being, you're going to have to give them such a huge return. You want to get out. You want to get them out. Mm-hmm. Otherwise, it becomes too high a mountain to climb.
Yeah. So Are there any pitfalls businesses must be aware of before they accept investment?
Yes. So I mentioned the one of the loss of control. So the loss of control is about getting out primarily, but it may also be a mechanism to lose strategic or management control. So you do get. So a venture capital view is that a CEO is probably only the right person for a certain stage of development, startup or growth or maturity, and at some point they think, well, the CEO needs to be recycled. So there'll be an element of control in the agreement, which that's a risk for the business. I think. In fact, can I come back to a point that you raised earlier about the focus on the team? One of the reasons for that is that if you're a really good team and you start out with your idea of podcasting, but in fact you see an opportunity to start making feature films, then you can, and your podcasting thing is doing okay, but it's not really driving enough revenue. If you've got a really good team, you can pivot the business and become a film producer. That's one of the reasons why they like teams, because they can adjust and move as necessary. But the flip side of that is that if you want to go in an area your investor doesn't want, that could cause a conflict or a difficulty.
And that's based on like any pre-agreements that you've had with them. If like, for example, you said if you initially agreed this, but then you've gone off and done this, then that's when a bit of strife may start.
Yeah, exactly. And we say, well, it could be that we just don't invest in those sort of things, or and then you've got a sort of kind of strategic argument. If the relationship is good, you'll get through it. You'll find a solution. But the pitfalls are fundamentally around the sale of. Primary pitfall is the sale of the business issue. You lost control of that.
Yeah,
that's the primary.
Yeah. I'm going to move on to what I call the quickfire round.
Okay, go for it.
Where I hit some questions.
I'll try and answer more succinctly.
Yeah. Does a business have to have a certain amount of cash in the bank before they can start seeking external finance?
Oh, thank you for that question. Who's that from?
It was me.
Oh, it's from you.
It was me.
Jacob, what a great question. So a game is, I'm going to retract that word. One of the things that often happens when you're raising venture money is that you'll be talking to the venture firm and they want to see over a period of time how your company develops before they commit to the investment. But they know that you'll get more anxious as you get closer to running out of money. It's a very good idea to have something in your back pocket. I mean, so that they don't allow the pressure of running out of money to be a weapon that they can use against you, essentially, in negotiation. So I would say it's very good to have access to money, particularly if it's not immediately visible. So there's a company I've been advising where exactly the investor is holding out because they are absolutely convinced the company's going to run out of money in January, so they're going to do a great deal before Christmas, kind of thing. But it's not, because it's going to get an R&D tax credit in January that will roll them over until probably at least a month, maybe 6 weeks. So just having a little bit of more cash buffer is great.
Yeah. Well, whilst you're speaking, another question came to me. How long does so let's say you're an investor and I need investment. From day one of me and you speaking, how quick is that transaction of you invest into my company? How long does it take?
Well, always longer than you think. If they say it can be done in a few weeks, they don't think it's probably not right. 4 to 6 months. 4 to 6 months. Sometimes longer.
Wow. Gosh.
Absolute bare minimum. I mean, obviously there are exceptions. People are going to, I'm sure the listeners, viewers are going to say, well, I know an example where it happened in a week or something. But just the process of deciding whether they want to invest, getting the initial approval from the investment committee, doing their due diligence, getting the final approval of the investment committee, agreeing the investment documentation, that just alone is several weeks.
Yeah.
So yes, raise investment without the financial pressure if you at all can.
Yeah. Next question. In your opinion, what are your top tips for a business owner who is seeking investment for their company? What should they be focusing on?
Understanding of the unit economics. You've got to understand what growth costs and what it delivers, which is really, and I'll give you, I can give you, I'll make that a bit more practical. I advised a firm in the e-commerce space that it was a very nice model. I don't want to give you too much information because you'll immediately work out who it is. But basically, they had a very large working capital requirement because the consumer paid later than you would normally in an e-commerce transaction. And if you run the numbers, you can just show that it needs a vast amount of capital to be able to grow. Sorting those things out first before you raise capital is so important to really understand what the financial metrics or financial drivers of the business are.
For those that may not understand what unit economics are, could you
Yeah, so
break it down
this is
in
a
layman's
sort
terms?
of financial babble here. Cost of a customer acquisition and the lifetime value of the customer is basically your growth. So you say, how many pounds, euros, dollars do I need to invest to win this customer? So let's say 5. And how many pounds, euro, dollars of margin am I going to get from that over the lifetime value of the customer? So I'm an e-commerce business, or you're a podcaster, and you know that you get a dollar a month in advertising from every active user. But it costs you $5 to be able to do the advertising to encourage them, or marketing to encourage them in. So your cost of customer acquisition is $5, and you've then got $1 a month. How many months is that person going to be an active user? On average, 12. So you put $5 in, you get $12 out. That's unit economics.
Okay.
That's not a very attractive example in mind, but just to give you
No, that makes sense. That makes perfect sense.
There is a lot of babble in finance, and working capital, which is how much it costs to service a customer, which is, do you have inventory? How much credit do you give your customers before they pay you? How much suppliers you have? Those current assets, current liabilities form working capital. Understanding that, if it's relevant to you, a lot of companies it's not relevant. And the unit economics are probably the two most important things to really be on top of.
Yeah. Well, thank you for answering that.
It's the first question I've answered.
I'd say so. I have just before we finish, I have a question. So if so what you said at the beginning is that investors, or most investors, are looking for, let's say, the ascension story, sort of thing. What if on the other side, where there has been a business who has made X amount of money, they have a good customer base, they have product offerings that are even still expanding, but they're running out of cash, or cash is gone, sort of thing. What advice would you give that sort of company when they're trying to potentially position themselves to receive investment again?
It's probably not venture investment because it's not going to have the growth story, but it could be attractive to private equity. So that's the classic. There's a very, so if you have your own company, eventually you're going to want to retire, and so eventually you're going to need to find a home for it. It could be your children, or keep it in the family, but eventually you're going to need to find a home. if it's big enough and it's cash generative enough, it could be attractive to private equity, and they'll be a great exit for the business. The other thing which is starting to emerge, which I think is really interesting development, is called a search fund, and they're for smaller companies. So basically what it is individuals who would like to own a business but don't have the capital. They come with themselves and an investor, and they will acquire your business. And so you're an SME, you're turning over a few million, you've got a nice lifestyle from it, but it's not something it's too small for private equity, and it's not high enough growth for venture capital. You may find that these search funds are interesting, and they're a relatively new concept, but really taking off. So that's great for succession planning.
Yeah, no, that's a really good response to that. Before we close out, is there anything that you wanna kind of say just to round up this conversation about?
No, if you'd like to know more on LinkedIn, I have
He's doing my job for me now. Go on.
I have a discussion called on venturing on. It's called, and these are discussion with investors and entrepreneurs. You're very welcome to go there and look at some of these discussions in a little bit more detail. No, I think I think it's to understand that at the stage of development of the company, there are different financing options that are available, and venture certainly isn't for everyone, but it's to understand when it's valuable and what the benefits and pitfalls are, as what I'd like the takeaway to be.
Well, thank you for joining us this morning.
It was a great pleasure, Jacob.
You've been
Thank you.
absolutely amazing. We've put a link in the description as well, and in the comments of how people can find you on venturing on as well.
Yep.
So, and also in the follow-up emails to this, there'll be a bit more information about how people can also get to that place as well.
Yeah, the corporate finance advisory business is Little Venice Partners, and we're happy to discuss with you if you're looking to raise capital, whether we can help you.
Yeah, you heard it here first. Top advisor, top man. Thank you so much for joining us this
Thanks
morning.
very much.
He was about to give me a fist bump, but there we go. Thank you so much for joining this morning,
Very well.
and have a great day, whatever you may be doing.
Thank you very much.
Thank you.
All right.
Have a great day, guys.
Bye now.